Welcome back to the Deep Dive. Today we're cracking open a book that's, well, it's been called, by far, the best book on investing ever written. That's Warren Buffett talking about Benjamin Graham's The Intelligent Investor.
Yeah, it's a classic, first published way back in 1949, which is kind of crucial context, actually, right after some really, really tough times in the market.
Exactly, and this isn't, a get-rich-quick guide or a list of hot stock tips.
Not at all. It's more like a blueprint, really. A system for making rational decisions when the world, especially the financial world, seems kind of irrational.
So our mission today is to do sort of intellectual autopsy on this book.
Mm-hmm.
Want to peel back the layers, get to the core logic, and figure out what wisdom in there is truly timeless.
Mm-hmm.
And the big question we're sort of grappling with, especially for this deep dive, is, okay, look at today's market. You've got meme stocks flying around, crypto going nuts, AI valuations, well, they're pretty wild. Is Graham's approach, his really disciplined, methodical rationality, is it more vital now? Or does it feel a bit quaint, outdated maybe?
Yeah, that's the real tension, isn't it? Does that old school framework still hold up when things feel so driven by narrative, by hype, by, frankly, speculation?
Let's try and figure that out. To really get Graham, I think you have to understand where he was coming from. What was the world like when he was putting these ideas together?
You really can't overstate the impact of, the historical backdrop and his personal life, too. We're talking about the long shadow of the 1929 crash, the Great Depression. It scarred an entire generation.
And for him, it wasn't just history in a book, right? He lived through financial disaster. His family lost pretty much everything back in the 1907 bank panic when he was just a kid.
Exactly. That hits hard early on. And then even after he'd become successful on Wall Street, he personally lost a huge chunk of his earnings in the 29 crash. So for Graham, these weren't abstract economic theories.
No.
They were real, painful losses. That kind of experience forces you to think differently, doesn't it? It demanded a whole new way to approach the market.
So he saw this fundamental problem, almost like a financial sin that was just everywhere back then. What was that, in his view?
It was basically speculation pretending to be investment. You had people chasing fast money, based on tips, rumors, emotions, just gut feelings.
Without doing the homework?
Without doing any real analysis of the actual business underneath the stock ticker. He saw the market being treated like a casino, a speculative vehicle, he called it. People acting like they could predict the future, predict these short-term price swings.
Ah, the classic trying to time the market, betting on where the price is going next instead of figuring out what the thing is actually worth.
Precisely. And Graham was convinced from painful experience that you just couldn't reliably predict those short-term movements. The market was too volatile, too emotional. If you didn't have a solid, grounded approach, you were basically set up for disaster.
Which is why he felt the need to offer something different, something based on reason, on safety.
Exactly. Which brings us to his core solution, value investing.
Okay, so how did he define that? What's the essence of value investing according to Graham?
He was very, very precise about it. He said, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything else
is speculation.
Yeah. Period. So it boiled down to those key things. Number one, you have to do thorough analysis. And number two, you need to ensure the safety of your principal, protecting your initial investment. Aiming for an adequate, not necessarily spectacular, return comes after that.
So it's not just about shooting for the moon. It's about doing the hard work first and making absolutely sure you don't get wiped out.
That's the foundation. And Graham, he didn't just see this as a financial strategy. He gave this distinction, investment versus speculation, a real intellectual, almost an ethical weight.
Interesting. How so?
For him, being an investor implied a certain diligence, a prudence. It was a responsibility. Speculation, on the other hand, was kind of absolved of that burden. It was okay to gamble, maybe, but don't call it investing, and don't confuse the two. This framework wasn't just about words. It came directly from seeing the wreckage caused by people treating the market like a game.
Okay, that's a powerful framing. So we've got the problem speculation and the solution value investing. But like any system of thought, it rests on some basic assumptions, right? What did Graham have to believe about markets for value investing to even make sense?
Yeah, there are a couple of really fundamental assumptions baked in. The first one is huge. A business possesses an intrinsic value. A true underlying worth that's actually separate from its constantly changing stock price.
So the price flashing on the screen every second, that's not the real value.
Nope. For Graham, a share of stock wasn't just a trading chip. It represented actual ownership in a living, breathing company. And the value of that company, its assets, its earnings power, its future prospects, that's its intrinsic worth. And critically, he believed you could estimate this worth through rational analysis.
Okay, like if you're appraising a house, the market might offer you wild prices day to day depending on buyer frenzy, but the underlying value is tied to the bricks and mortar, the location, the rental income potential, that sort of thing.
That's a fantastic analogy. The stock quote is just the market's opinion today, which can be, frankly, all over the place. The intrinsic value is the reality you're trying to figure out through careful work.
Okay, makes sense. And what was the second core assumption?
The second one is just as crucial. The market isn't always efficient in the short run, but it will eventually recognize and correct mispricings over the long term.
So it could be crazy for a while.
Exactly. If the market was perfectly efficient, if prices always reflected all information instantly, there'd be no bargains. There'd be no opportunity to buy something for less than it's worth. Graham's whole approach depends on the market being temporarily irrational.
Mr. Market having his mood swings.
Right. But it also depends on a fundamental belief that eventually reason wins out, that the market will, over time, sober up and value companies based on their actual fundamentals.
So it's the famous voting machine versus weighing machine idea.
Yeah.
Short term, it's a popularity contest. Long term, it weighs the substance.
That's exactly it. And it's kind of fascinating, isn't it? Graham himself suffered hugely from market irrationality, like in 1929. Yet his entire system is built on this underlying faith that eventually rationality prevails and the market will validate true value. There's a real optimism embedded in there.
It implies that if you do your homework, find that value, and wait patiently, the market will eventually catch up to your analysis. Without that belief, buying cheap doesn't really work as a long-term strategy.
Precisely. That long-term convergence is key.
Okay, so we have the problem, the solution, the underlying beliefs. Now, how did Graham make this practical? How do you actually do this? What's the sort of mental operating system he provides?
Right. How do you put it into action? I think you can break it down into maybe 3 core pillars, all interconnected. The first one is all about dealing with that market craziness, using the twin concepts of Mr. Market and the margin of safety.
Mr. Market. Probably Graham's most famous creation. Let's unpack him.
Okay. So Graham asks you to imagine you co-own a business with a partner named Mr. Market. Now, this partner is, let's just say he's emotionally volatile.
Bit of an understatement, usually.
Right. Every single day he comes to you and offers to either buy your share of the business or sell you his share. He names a price. Every day.
And some days he's bouncing off the wall, super optimistic, offering a ridiculously high price.
Totally euphoric. And other days he's utterly miserable, panicked, convinced the world is ending, and he'll offer you the business for peanuts.
He's manic depressive, basically.
That's the classic description. He's emotional, irrational, driven by fear and greed. But here's the absolute key. You are under zero obligation to trade with him. His daily price quote is strictly for your consideration. He's there to serve you, not to guide you.
So his price doesn't tell you what the business is worth. It just tells you what he is feeling today and what price he's willing to transact at.
Exactly. Graham invented this character as a psychological tool to help investors detach themselves from the market's wild swings, to stop people from letting Mr. Market's mood swings dictate their own judgment of value, or, worse, panic them into buying high and selling low.
It's like having that emotional weather reporter we talked about. Just because they're screaming about a blizzard doesn't mean you need to board up your windows if you look outside and see sunshine. You check the reality.
Perfect. You trust your own analysis, not his hysteria. Now, to safely navigate Mr. Market's offers, especially when he's feeling depressed and offering low prices, you need his essential companion, the margin of safety.
Okay, the second key concept, what is that exactly?
This is maybe the most important single idea in the book. It's the principle of buying a security only when its market price is significantly below your conservative estimate of its intrinsic value.
So back to the house analogy.
Yeah.
If you think a house is really worth $500,000 based on your research,
you wouldn't pay $500,000, or you wouldn't even pay $480,000. You'd look to buy it only if Mr. Market, in one of his depressed states, offered it to you for, say, $300,000 or $350,000.
That difference, that $150,000 to $200,000 gap, that's the margin of safety.
Exactly. A 30-40% margin in that case. And again, this wasn't just some abstract financial theory for Graham. You have to remember his background.
The trauma.
The trauma, losing money, seeing his family lose money, the sheer unpredictability he experienced. The margin of safety was his rational response to that. His, as one writer put it, antidote to financial trauma.
Wow, so it's born directly from needing protection, needing a buffer against disaster.
Absolutely. He called it the central concept of investment. Why? Because it provides, in his words, room for human error. Your analysis might be wrong, the future might turn out worse than you expect, bad luck happens. The margin of safety is your cushion. It protects you when things don't go according to plan.
It absorbs the shock.
It absorbs the shock. So, putting them together, Mr. Market, in his wild swings, occasionally offers you an opportunity of very low price. The margin of safety principle is the rule that tells you whether that low price is low enough to justify acting, given the uncertainties involved.
So it's a framework for rational action. It shifts the focus completely away from trying to guess market direction,
Which Graham thought was futile.
towards rigorously assessing value and demanding that protective cushion. It's about controlling what you can control, your analysis, your purchase price, your own emotions, not trying to predict the unpredictable.
You got it. That's the core operating system right there.
Okay, so we understand the mindset, watch Mr. Market, demand a margin of safety. How did Graham suggest people actually put this into practice? Did he lay out specific, rules of engagement?
He absolutely did. And it all starts with being crystal clear about that fundamental distinction we talked about earlier, investment versus speculation. He really wanted to reclaim the word investor.
Don't just throw it around loosely.
Right. He insisted, which game you're playing. And if you do choose to speculate, which he didn't forbid, but was very wary of, he had strict advice.
What was that?
Keep it totally separate. Use only a small part of your capital, maybe 10% or less, money you can afford to lose. Put it in a separate account. Use a separate mental framework. Never, ever mix your speculative activities or mindset with your serious investment capital. Speculation is about anticipating price moves. Investment is about buying value with a margin of safety.
Got it. Keep them walled off. And building on that, he recognized that not everyone has the same goals or the same amount of time or expertise.
Right.
That led to his two types of investors.
Yes, crucial distinction. The defensive investor and the enterprising investor. He knew it wasn't one size fits all. You need to understand yourself first, your temperament, your available time, your level of interest and skill.
Okay, let's start with the defensive investor. Who is that person? What's their game plan?
This is someone whose main goals are, number one, avoid serious losses, and number two, get a reasonable, sort of adequate return without needing to put in a ton of effort or make complex decisions. Freedom from bother, he sometimes called it.
So safety and simplicity are key.
Exactly. And for this type, Graham laid out very specific, almost mechanical, quantitative rules. First, diversification. Don't put all your eggs in one basket. Own a decent number of stocks, maybe 10 to 30, spread across different industries.
Makes sense.
Second, company quality. Stick to large, prominent, financially sound companies. Think big, established leaders in their fields. He suggested criteria like minimum size, maybe $2 billion or more in assets in today's dollars, and conservative financing.
So blue chips, basically. Companies with staying power.
Yes, exactly. Third, stability. Look for a long history of consistent profitability. He required positive earnings for at least the last 10 consecutive years. And fourth, dividends. A long, uninterrupted record of paying dividends. Ideally 10 years, even better if it was 20 years or more.
Wow, those are pretty strict filters. And then the price part was critical for the defensive investor too, wasn't it? Don't overpay.
Absolutely non-negotiable for the defensive approach. He gave explicit price limits. Don't pay more than, say, 15 times the company's average earnings over the last few years. And don't pay more than 1.5 times its book value, the company's net assets.
Okay.
He even had a combined rule to be extra cautious. The price-to-earnings ratio multiplied by the price-to-book ratio shouldn't be more than 22.5. So if the PE is 15, the PB can't be more than 1.5. 15 by 1.5 equals 22.5. Very conservative, all designed to build in that margin of safety automatically.
So the defensive investor strategy is like buying a really well-engineered Volvo. It might not be the fastest car on the road, but it's incredibly safe, reliable, and built to last.
That's a perfect analogy. Safety first, minimal fuss, dependable results. Now, contrasting that, you have the enterprising investor.
Okay, who's this? Someone looking for more excitement.
Not necessarily excitement, but definitely aiming for potentially better than average returns. This is someone who is willing and able to devote significant time, effort, and intellectual energy to the process.
So more hands-on.
Much more. But, and this is crucial, Graham was adamant about this being. Enterprising is not about taking on more risk than the defensive investor. It's about applying superior skill and more intensive analysis to identify opportunities the market might be missing.
Like finding undervalued securities that don't meet the strict defensive criteria, or identifying special situations like mergers or reorganizations.
Exactly. They need to do deeper dive, more complex analysis. They have more flexibility in their portfolio construction, maybe holding fewer stocks if they have high conviction, or having a higher allocation to stocks overall, perhaps up to 75%. But even then, Graham insisted they always keep at least 25% in bonds or equivalents for stability.
So it's not about being reckless. It's about being smarter and working harder, like a skilled rally driver. They're going faster, but their focus is absolutely on control and avoiding the crash.
Another great analogy. They push the limits, but with intense focus and skill, not bravado.
These categories really make sense. They give people clear paths based on their own circumstances and commitment level. It avoids that one-size-fits-all trap.
Absolutely. And it sets realistic expectations. The defensive path offers a sound, accessible way for almost anyone to invest prudently. The enterprising path sets a very high bar. It requires serious dedication. Graham was basically warning people not to dabble, not to think they could get enterprising results with defensive effort. Know yourself, choose your path, and stick to the discipline it requires.
Okay, so we have the mindset, the rules of engagement, the investor types. But Graham knew, didn't he, that even the best system falls apart if you can't handle the psychological pressure. He put a huge emphasis on temperament.
Tremendous emphasis. You could argue it's the capstone of his entire philosophy. Mr. Market helps you deal with the external chaos, the market's volatility, but the margin of safety, the rules, none of it works if you can't manage your own internal state, your fear, your greed, your impatience.
And he famously said that temperament was actually more important than intellect in investing success, right?
He did. It's a pretty bold claim. He argued that he'd seen many brilliant people lose fortunes in the market because they lacked emotional discipline. Conversely, he believed ordinary people with the right temperament, even if they weren't geniuses, are far more likely to achieve satisfactory results over the long run. Intellect helps, but temperament is king.
So what exactly did he mean by the right temperament? What are the key psychological traits?
He highlighted a few core things. Patience and discipline are huge. You need the patience to wait, sometimes for years, for the right price, for Mr. Market to offer you that bargain, and the discipline to stick to your analysis and your plan, even when the market is going wild or your stocks are temporarily out of favor.
Resisting the urge to constantly tinker or follow the crowd.
Exactly. Which leads to the next trait, independent thinking. Having the courage to go against the herd when your analysis tells you the crowd is wrong. Graham loved the phrase that the intelligent investor aims to sell to optimists and buy from pessimists. That requires a contrarian streak, or at least the ability to think for yourself.
And finally, emotional control.
Absolutely critical. The ability to mitigate or at least manage the powerful emotions of fear during market crashes and greed during speculative bubbles. Avoiding impulsive actions driven by those emotions is maybe the single biggest challenge for most investors.
It sounds like being a seasoned ship's captain in a storm. You feel the waves, you see the lightning, but you don't panic. You stick to your charts, trust your instruments, your analysis, and an intrinsic value estimate, and navigate based on those, not based on the other ships spinning in circles around you.
That's a perfect way to put it. The captain stays calm, focuses on the destination, long-term value, and the process, despite the surrounding chaos. Graham understood that the biggest risks often don't come from the market itself, but from within the investor. Your own psychology can be your worst enemy.
He was basically outlining the core ideas of behavioral finance decades before it became a formal academic field.
He really was. He intuitively understood that your mental and emotional fortitude, your temperament, writes the real script for your investment success or failure, perhaps even more than your analytical skills.
Okay, this is a remarkably coherent and psychologically astute framework he built. But now the big question remains, how does it hold up today? Let's stress test these ideas against the modern market. Think about tech giants, intangible assets, the speed of information now. Where does the Graham approach start to bend or maybe even break?
Right. This is where the rubber meets the road in the 21st century. Let's try applying his lens to a company everyone knows, a modern behemoth. Meta Platforms, Facebook's parent company. Could a strict Graham investor, following his rules, actually buy Meta today?
Okay, let's walk through the checklist. Size and prominence. Definitely. Huge, dominant company. Check.
Financial condition. Generally pretty strong balance sheet, lots of cash, meets many of his standard tests for financial strength, so check.
Earning stability. Yep. Consistently profitable for over a decade now. Check. Earnings growth. Historically, it's been absolutely spectacular. Check again.
Okay, so far so good on the quality front. Now let's think about the defensive investor criteria. Dividend history.
Meta only recently started paying a dividend. It doesn't have that long 20-year uninterrupted track record Graham liked for defensive stocks, so it fails that specific defensive test.
Right. But the really big sticking point for any strict Graham analysis, whether defensive or enterprising, usually comes down to the price ratios. Valuation. Meta, like many large successful tech companies, often trades at a price-to-earnings ratio and a price-to-book ratio that are way, way higher than those conservative limits Graham set, like PE below 15, PB below 1.5, or that combined product under 22.5.
So by those strict quantitative rules, there's just no margin of safety.
Often, yes, according to a rigid application. If you actually plug Meta's numbers into some of the specific formulas Graham proposed, analysts might calculate a hypothetical Graham defensive price of maybe, say, $160 a share and maybe an enterprising price around $135.
Yeah, the stock has recently been trading closer to, what, $500, $600 more?
Exactly, orders of magnitude higher. Even more sophisticated valuation methods like discounted cash flow models often show it trading well above estimates of intrinsic value derived using conservative assumptions.
So if we had to give Meta a Graham grade,
you'd probably say it's a high-quality business, maybe passes some enterprising business quality checks. But on the crucial test price paid versus estimated intrinsic value, it often fails to offer a sufficient margin of safety according to Graham's quantitative framework. A strict Grahamite, especially a defensive one, would likely look at the price and say, great company, but it's just too expensive for me right now.
This Meta example really highlights one of the major challenges, doesn't it? Where does Graham's system struggle most in today's market?
I think the single biggest challenge is valuing modern companies, particularly in tech and other high-growth sectors, where so much of the value comes from intangible assets. Graham built his toolkit in an era dominated by industrial companies, where tangible assets, factories, machinery, inventory were paramount. His methods leaned heavily on analyzing those physical assets and stable historical earning streams.
But today, value creation is different. It's often driven by things like brand reputation, network effects, proprietary software, user data, intellectual property, stuff that's hard to pin down on a traditional balance sheet.
Exactly right. Some estimates suggest that intangible assets now make up something like 90% of the total market value of the S&P 500. Graham's heavy focus on book value, especially the price-to-book ratio, becomes much less meaningful, potentially even misleading for asset-light, knowledge-intensive businesses. If you rigidly follow only his old quantitative rules, you might systematically screen out many of the most successful companies of the modern era.
Yeah, how do you calculate the intrinsic value of Instagram's network effect using Graham's 1949 PV ratios? It just doesn't quite fit.
It's really difficult. His methods generally require inputs that are reasonably stable and predictable. But how do you do that for a pre-revenue biotech startup? Or a company operating in a rapidly evolving field like AI where the future is incredibly uncertain? Calculating a precise intrinsic value with a high degree of confidence becomes much harder in those situations, challenging the very foundation of his process.
And modern critics like Professor Aswath Damodaran at NYU point out other shifts too, right?
Yeah. Yes, Damodaran makes some really interesting points. He argues, for instance, that the investment world has become flatter. Back in Graham's day, just doing the basic quantitative analysis he recommended gave you a significant edge because that data and the tools to analyze it weren't widely available.
Information asymmetry was huge.
Exactly. Today, anyone with a brokerage account can run sophisticated quantitative screens in seconds. The edge you get from simply replicating Graham's specific numerical filters from the 1940s is arguably much smaller, if not gone entirely.
Everyone has access to the same basic numbers now.
Pretty much. And Damodaran also emphasizes how the global economy itself has changed the rise of dominant tech platforms, the importance of the globalization, and again, the shift towards intangible assets. He suggests Graham's framework, rooted in the tangible, asset-heavy, more domestically focused U.S. economy of the mid-20th century, needs significant adaptation. Those specific PE or PB multiples might simply be outdated.
Plus, you have the whole rise of passive investing changing market dynamics.
That too. And all this fuels the recurring debate you hear whenever growth stocks outperform value stocks for a period. Is value investing dead?
Right. We hear that cycle again and again.
It's perennial. Now, the strong counterargument is that value investing isn't dead, it just needs to get smarter. It needs to evolve perhaps by incorporating other factors like quality and profitability alongside price, or by finding better ways to estimate the value of R&D spending and those tricky intangible assets. There's also the ever-present danger of value traps, stocks that look cheap based on old metrics, but are actually cheap for very good reasons, like their business is in terminal decline.
Okay, so summing up the challenges. Graham's core principles: the absolute necessity of rational analysis, focusing on underlying value, not just price, managing risk rigorously, controlling your emotions, knowing what you own. Those seem timeless, right?
Absolutely. I think those are universal principles of wise decision-making under uncertainty.
But the specific application, the particular tools and rigid quantitative rules he developed back in 1949, especially the heavy reliance on tangible assets and specific numerical cutoffs, those are definitely challenged by today's world of intangible value, rapid technological change, and globally interconnected, information-rich markets.
I think that's a fair assessment. The enduring spirit of Graham, the intellectual honesty, the discipline, the focus on safety remains incredibly valuable. But manifesting that spirit effectively today likely requires updating the toolkit.
Okay. We've done this deep dive, this intellectual autopsy. We've explored the historical context, the core logic, the operating system, the psychological armor, and now the modern challenges. If you had to distill it all down, if you had to pick just one single mental tool from Graham's entire arsenal, the one concept that's the most powerful, most universally applicable, even beyond finance, what would it be?
That's a great question. Because you look at the whole thing. The intelligent investor isn't just a jumble of advice, it's really a coherent system. A system for thinking rationally when faced with uncertainty, designed fundamentally to preserve your capital, to avoid disaster. It forces you to be clear about what you're doing, to know yourself, to think independently, and crucially, to build in buffers. And if I have to pick just one piece, I think it has to be the margin of safety.
The cushion, the buffer.
The buffer, yes. But thinking about it even more broadly than just buying stocks cheap, I see it as a fundamental principle for living and decision-making. The principle of consciously building a robust buffer against the unknown and the unknowable in any situation where the consequences of being wrong are significant.
So not just finance.
Not just finance at all.
Okay.
At its heart, the margin of safety is a profound recognition of our own limitations. It acknowledges that we don't know everything, that the future is inherently unpredictable. It's an exercise in intellectual humility.
Why do you think that concept is the most powerful takeaway?
Because its usefulness is so incredibly broad. It's universal. Think about applying it to your career, maybe developing a diverse skill set, so you're not overly reliant on one specific job or industry. That's a margin of safety.
Okay, I see that.
Or in engineering, why does a bridge engineer design a bridge to withstand loads far greater than anything typically expected? That's margin of safety against unforeseen stresses or calculation errors. In business, why do well-managed companies maintain strong balance sheets with plenty of cash, even when times are good? Margin of safety against unexpected downturns. Even in personal life, having an emergency fund, having backup plans. It's about asking, in any important decision, what is my margin of safety here? How much room for error have I allowed?
It forces you to confront uncertainty head-on and what you don't know.
Exactly. It's a direct antidote to overconfidence, which is poison in any decision-making field. And fundamentally, it builds resilience. That buffer is what allows you to survive mistakes, setbacks, bad luck, unexpected shocks. It lets you stay in the game, whether that game is investing, running a business, or navigating life.
And it really resonates when you connect it back to Graham's personal history.
It absolutely does. Knowing it was born from his own painful experiences with financial trauma gives it incredible depth. It's not just an abstract theory, it's wisdom forged in fire. It's profoundly practical.
It tells you when the odds are sufficiently in your favor to act.
Right. It provides a decision threshold. You demand a potential reward that significantly outweighs the risks, and you ensure your entry point, your commitment, is well below your conservative estimate of value or well within your capacity, with a cushion that's proportionate to the level of uncertainty involved.
Like that bridge engineer again, building extra strength to handle earthquakes or floods they can't perfectly predict.
Precisely. An intelligent decision maker in any domain consciously builds in that extra capacity, that buffer against the unforeseen. The margin of safety principle accepts human fallibility, that essential room for human error Graham talked about. And it protects you not only from external volatility, but also from your own inevitable mistakes in judgment. It's just profoundly wise and applicable anywhere the cost of being wrong is high.
So Benjamin Graham's The Intelligent Investor. Written, over 70 years ago now? In a financial world that feels almost alien compared to today's meme stocks and algorithmic trading. And yet, our deep dive suggests there's still incredible, enduring wisdom there.
Absolutely.
The intellectual autopsy shows that, maybe the specific tools, the exact quantitative rules need some updating for the modern age of intangibles and rapid change. The core logic, that seems timeless.
I'd agree. The discipline to resist Mr. Market's emotional siren song, the insistence on understanding the value of what you own, the critical recognition that your own temperament might be your biggest asset or liability, and maybe above all, that fundamental demand for a margin of safety. These ideas feel as relevant and crucial today as they were in 1949, maybe even more so in some ways.
It really is a system for rational survival, isn't it? In what often feels like a deeply irrational world. The tools might need sharpening for the 21st century, but the underlying principles seem rock solid.
Well said.
And maybe the ultimate takeaway from revisiting Graham isn't just about investing. Maybe it's that intelligent decision-making in any important area of life is this ongoing process. It requires continuous learning, adapting to new realities, and maybe most importantly, thinking critically and independently for yourself. The specific formulas might evolve, but prudence, rigorous analysis, and that hard-won emotional discipline, those seem like constants.
Absolutely. And perhaps a final thought for everyone listening. Take a moment and just consider, where in your own life, financial or otherwise, could you benefit from consciously building in a greater margin of safety right now?
That's a powerful question to ponder. Thanks for joining us on this deep dive. We'll be back next time to unpack another influential text here on the Deep Dive.